everyone, and a very warm welcome to the Retail Market Conduct Drivers and Current Regulatory Approaches webinar hosted by the IOSCO Asia Pacific Hub. We're thrilled to have all of you here with us today as part of our ongoing efforts to promote knowledge sharing among IOSCO members. We have a great lineup of speakers today, and I'm delighted to introduce our moderator, Gerard Fitzpatrick. Gerard is responsible for the international team at the Australian Securities and Investments Commission, also known as ASIC, and his team engages closely with peer regulatory authorities and international organizations to develop international regulatory policy and coordinate international cooperation requests. Gerard's previous roles at ASIC include leading investment managers and superannuation, and earlier credit. Before joining ASIC, he led policy and government relations at the Financial Planning Association of Australia. He also held senior leadership roles at the Institutional Money Market Funds Association and Investment Management Association in London. Gerard's previous regulatory roles included markets and international responsibilities at the UK FSA and international economic analysis and prudential supervision at the Bank of England. An economist by background, Gerard also taught economic and business-related topics at universities in the UK. We have over 220 participants registered today, mainly from the Asia-Pacific region, but also from other parts of the world as well. We hope that you find today's discussion informative and engaging. And if you have any questions for the speakers throughout the session, please use the Q&A function provided, and they will be answered accordingly. Today's webinar will last approximately 1.5 hours. And without further ado, I will now hand over to Gerard to introduce the topic as well as our esteemed speakers. Over to you, Gerard.
Thank you, Shabana, and welcome everyone to today's webinar on the topic of retail market conduct drivers and current regulatory approaches. I'm delighted that you're attending this presentation about such an important topic. Now, before I introduce our speakers, I would like to begin by acknowledging the traditional owners' ongoing connection to and custodianship of the lands on which we meet today, and to pay my respects to elders past, present and emerging. For my location, that is the Gadigal people of the Eora Nation. That is the acknowledgement of country that is done before meetings that are located in Australia. So thank you. This webinar aims to discuss the challenges in the retail investment landscape in recent years, including the emergence of digital platforms, the increasing popularity of self-directed trading, and the influence of social media on retail investor behavior. While these developments have provided new opportunities for investors, they have also raised concerns about the potential risks and challenges posed to retail investors, particularly those who may lack experience or knowledge in this space. Today's webinar is being held in conjunction with the recent release of IOSCO's Retail Market Conduct Task Force final report, which is a significant contribution to IOSCO's efforts to address retail market conduct challenges in the increasingly digitalized financial landscape. The task force was co-led by IOSCO, ASIC and the Central Bank of Ireland, and the final report builds on the IOSCO report on retail market conduct implications of the COVID-19 pandemic, which was published in December 2020, and a consultation report which was published in March of last year. The final report focuses on the impact of digitalization, demographic factors, and changing macroeconomic conditions on retail investor trading activity, including the impact of social media and influencer activities, the surge in self-directed online trading and riskier products, the escalation in unlicensed activity accompanied by novel fraud patterns, aggressive digital marketing practices by market intermediaries, and an exploration of recent supervisory and enforcement issues emerging from the increasing cross-border nature of retail misconduct. To combat these risks, the report offers a comprehensive toolkit of adaptable measures for regulators to consider when dealing with retail market conduct issues. The toolkit encompasses innovative approaches under 5 broad categories, including heightening regulators' own digital presence, honing approaches to better address misconduct, including preventative means to help early detection and or mitigation, addressing retail investor harms from crypto assets, although I would note and acknowledge the work of the IOSCO FinTech Task Force in its ongoing presence in this space, and implementing new regulatory approaches and enhancing cross-border supervisory and enforcement cooperation frameworks. The report is a point-in-time review, and further work will continue on the various themes identified. Overall, the report is a valuable resource for regulators seeking to protect retail investors and combat financial fraud across international borders. By providing actionable insights and practical recommendations, the report serves as a critical step towards building a safer, more resilient financial ecosystem. Now, for those of you who are interested in delving deeper into the recommendations and insights, there is a much more useful information and available within the report, including links to more granular detail. And I would encourage you to access directly the report. It's available on the IOSCO website. Now, with that, I'm pleased to have with us a distinguished panel of experts who will share their insights on this important topic. Joining us today are, first of all, Talis Putnins, who is Professor of Finance at the University of Technology, Sydney, and the Chief Scientist of the Digital Financial Co-operative Research Centre. Talis specialises in financial markets, including market design and the use of technology and data in trading, misconduct and crime in financial markets, including market manipulation, insider trading and scams, and digital finance, including decentralized markets and tokenization. Talis serves as a consultant and advisor to regulators, stock exchanges, and financial institutions in several countries. He's served as an expert witness in legal matters concerning financial markets and securities, and has published in leading academic journals and authored industry reports and policy briefs to government, and teaches a national PhD course in financial market microstructure and digital finance. He's held faculty and visiting positions at Columbia University, New York University, the University of Edinburgh, Stockholm School of Economics, and has a PhD from the University of Sydney. Angelina Kwan is the CEO of Stratford Finance Limited and a regulatory expert, having worked on the foundation legislation and guidelines that would later be a part of the Virtual Asset Service Provider framework for Hong Kong. She lectures internationally on VASP and other regulatory topics. Previously, the group COO at HashKey Group and other leading global crypto derivatives exchanges, Angelina also held senior directorate positions with the Hong Kong Securities and Futures Commission, Hong Kong Exchanges and Clearing Limited, Cantor Fitzgerald, and other financial services firms. And Miles Larbey, who's the head of the Financial Consumer Protection at the Organisation for Economic Cooperation and Development. In this role, he leads the OECD's global work on financial consumer protection policy and supports the G20 OECD Task Force on Financial Consumer Protection and FincoNet. Miles has over 20 years' experience in consumer protection law and policy, conduct supervision, and financial capability. His particular areas of emphasis include the impact of digitalization, sustainable finance, demographic changes, the protection of vulnerable consumers, and financial inclusion. Before joining the OECD, Miles held senior executive positions responsible for financial capability in banking and insurance supervision at the Australian Securities and Investments Commission. Additionally, he was the first general manager of the Investor Education Centre in Hong Kong. Before we move on to our panel discussion, I'd like to remind everyone that we will be taking questions throughout the webinar as they come through. So please feel free to type out your questions in the Q&A box. Now, let's get started. Now, to open up the questions, I'd just like to ask the panel, and perhaps we can go, each of you, to answer these first few questions. Over recent years, and particularly since COVID-19, securities regulators have been on heightened watch over the retail landscape due to increasingly significant retail participation. Could you please provide a brief overview of the recent landscape and offer your perspectives on why retail participation has increased so significantly over the past few years? And on that, I might start with Miles.
Thank you very much, Jed, and it's a pleasure to join this seminar organised by IOSCO today, and let me congratulate IOSCO on the release of the final report of the Market Conduct Task Force. I think it's a terrific piece of work and a really great addition to the thinking and approaches in this space. I'd say that it's all evidence suggests that retail participation in markets across the board has been growing over the last 5 to 10 years. But this growth by retail investors was significantly pronounced or enhanced during 2020 and 2021, during the COVID pandemic period. This is obviously borne out by a lot of research and evidence from trading volumes. We also conducted some research during the COVID period to understand the experience that financial consumers and investors were having, which found that one of the most striking impacts of COVID-19 on the retail investment market was the rapid entry of many and sometimes new retail investors into the market, especially during periods of lockdown. And the dramatic growth in the number of retail investors, reporting that the number of retail investor accounts in many cases had doubled from 2019 then to 2020. And what we've seen is those trends really continue into 2022 and 2023, and that's right around the world. So in the US, I think JP Morgan reported in January that retail market orders as a percentage of market value were at 23%. In India, I think about 50% of daily transactions in the market are with retail investors. And in France, the AMF Retail Investor Dashboard continues to show strong participation by retail investors in the market in 2021 and 2022, with 1.5 million retail investors active in equity markets in France. So we can see right around the world this massive acceleration that occurred during the COVID-19 time, and that has sort of continued on into this year. In terms of the reasons for this, I think again there are a number of research reports and that have been written on this, and not least obviously the IOSCO market conduct report itself. And I think these reasons are many, but they include things such as people having greater access to markets enabled by digital platforms, apps, and so on. More opportunities to buy stocks at lower prices. And I mean, I think frankly, during the COVID-19 time, more free time to engage in trading during lockdowns and so on, and coupled with the influence of social media. Jed, you mentioned already finfluencers, I think, which have been playing a large role in this space in terms of the retail, influencing retail investors and their participation. So I think it's down to a number of different reasons that has seen this significant shift.
Thank you, Miles. I might ask the same question to Angelina.
I believe Miles has covered basically the macro environment in terms of what has been happening with the retail markets in Hong Kong and in Asia. Basically, you've seen the resurgence of electronic trading and the gamification, as well as the opportunities for investors to either trade in very simple to use trading companies. And you're seeing the surgence of crypto. A lot of people during the COVID crisis really entered the crypto market. They were already very active in crypto. Now there's even more people in digital assets. So because of the ease of entry and opening accounts in many of these electronic trading companies, you're seeing, for example, Hong Kong. I'm just looking at some of the stats. Between from 2016, it was at around 66 billion. By 2022, we're at 124 billion in terms of daily turnover of stock. So you're seeing stock markets just balloon, and they really ballooned between 2021 and 2022 in terms of the turnover. So not only did you have investors that were sitting home bored, they had an opportunity to trade. Maybe some people were out of work, so they had the opportunity to make money on the side. And then you're seeing the Twitter, Reddit gang basically inform investors, oh, these are stocks that you should be looking at, and so on and so forth. So I think that actually sparked a lot of interest. One interesting thing that happened in Hong Kong recently is there were a number of trading firms in Hong Kong that were banned because they were so popular. They were actively marketing into China, and Chinese investors were starting to really flock into the Hong Kong market. And the SFC issued a ban on people opening these accounts with this particular or two particular brokers, just to try to dampen the exuberance of Chinese investors across the border and in trading in Hong Kong. So you've got the availability, you've got margin loans that are easily accessible, you've got digital assets that are easily accessible. That makes for customer choice, and that makes for a lot of people piling into the market. And even now that COVID has subsided, you're still seeing people trade very, very actively. Although people can go shopping outside, you're still seeing a very, very high stock turnover in Asia Pacific. Almost all the markets are basically seeing this now. That's just a brief what's happening in Asia.
Thanks, Angelina. And tell us your view on these themes.
Thanks for having me on the webinar, and I'll start just by seconding what Miles said. I think it's a fantastic report, and to show that I'm not just giving a lip service, I'm teaching a class on market structure tomorrow morning, and I'll be taking the report with me into class and assigning it to students as background reading to get them up to speed as to what's happening in this area. So I think it's a very, very, very useful piece of work. What can I say about the retail trends is my research group have been digging in a little bit and constructing empirical measures of not just total retail trading activity, but the nature of the trading activity. So we've been trying to isolate the amount of gambling that happens in stock markets. And so the empirical measures that we've developed focus in on a select group of stocks in the cross-section of stocks in the market that would be the most attractive to people that had a predisposition towards gambling. So these are stocks that have very skewed payoffs, very small probabilities of an extremely large return, and very high probabilities of actually a very low return. And what we do is we measure excess turnover in those stocks relative to other stocks in the market. And this allows us to get a measure of how much gambling activity happens in the market. And so we've been tracking this measure through time, and we see two things. One is this measure was trending upwards already before COVID. So there was something structural going on in the markets pre-COVID. And then, of course, when COVID hits, we see a sharp spike up in this measure as well. So it's mirroring the overall patterns of what we're seeing with retail trading activity, but specifically isolating the trading activity that can be associated with gambling tendencies. And so I think the fact that there's a background trend before COVID hits can be largely attributed to things like more accessible and lower cost trading to retail participants, the Robin Hoods of this world, etc., gamification of trading, and the influence of social media on trading patterns and the way that people, in particular retail individuals, are forming trading decisions. The spikes that we see around COVID can be linked to boredom, is one of the key hypotheses that's out there, and it's supported by the data that specifically when a lockdown hits is when you see, if you zoom right in, that's when you see the spike in activity. But there's also another explanation, which is the psychology literature links gambling propensities to factors such as anxiety, isolation. These are circumstances that trigger someone's propensity to gamble. And so that's the second sort of explanation why, in particular, when COVID hits, we see that additional spike over and beyond what those long-term structural trends were.
And it's interesting because people are out of work, they can't go work, or they may be stuck at home and they need to make additional income. So that's another area also. So the gambling plus the lack of jobs, lack of money coming in, all probably contribute together to this increased interest. So.
Indeed, and what the literature shows is that unemployment is one of the key predictors of the total level of gambling in a country, which might seem a little bit counterintuitive or a bit harmful, but that's the way it is. When people don't have employment is actually when that type of activity tends to peak.
Thank you. And I think some mention's been made about the continuation of some of these trends. I'd like to explore that a little bit more, if I may, and perhaps starting with you, Angelina, is one about what's happened since COVID and what's your prognosis for what the trajectory is going forward, and also how the new investment technologies and platforms contribute to these trends. And are there any trends that regulators need to be calling out and be more aware of? And I'll also ask this to the other panelists as well, but perhaps Angelina, if you could take the first.
Sure. I think the biggest trend that you're seeing, which all regulators in IOSCO are grappling with, of course, is the rise of digital assets and the regulation that's coming in market by market. And regulators are all working on their different forms of regulating and how to regulate digital assets for retail, for institutional investors, and not to mention CBDC and a number of different products, including tokenization, that are coming out of the digital asset space. So I think with this, I talked about how Hong Kong's turnover has just gone up threefold. It's still staying up there. And one of the reasons why is Hong Kong's markets, of course, have opened to China, but there's been a bit of a pulling back because China doesn't want, and that's why the ban, doesn't want so many people investing into the stock market. And of course, moving of funds cross-border, that's been an issue. But nevertheless, there's great interest in China, and there's been great interest, and it's continuing to be the same in terms of in Hong Kong with the Hong Kong stock market. And now we have the Connects in place where you can also trade Chinese stocks too. So that continues, but now with the introduction of digital assets, and the SFC has launched a new consultation paper that is going to come through, we will have the licensing of digital asset providers, and retail will be allowed. So we expect, with protection of investors, that more people will start exploring to get into the digital asset space. Traditional brokers have also been allowed to uplift their licenses. So those 602 traditional brokers in Hong Kong, a proportion of them will seek to get licenses to be able to trade for their retail investors to get into digital assets. So the trend of being able to trade traditional assets as well as digital assets, I think, is going to grow. And in 3 years to 5 years' time, digital assets are just going to be another financial services product. We're already seeing Bitcoin exchange-traded funds, ETFs, already traded on the stock market. And it's going to be the next jump, of course, to see that a traditional stock market offer the trading of Bitcoin. So you're already seeing CME trading Bitcoin futures, while you're going to see exchanges around the world that are traditional stock that will probably start offering Bitcoin and Bitcoin futures also. So this will be a big thing, and that will keep the whole hype going. Meanwhile, the information flows are still growing. There's been no stoppage of Twitter, as well as Reddit, as well as a number of KOLs pushing out the message about trading and their views. Same ones that actually affected GameStop and some of the areas that you covered in the retail report. And I think it's so important for regulators around the world just to be very aware that information is passing so quickly, and more enforcement and working together as IOSCO will be very, very important to make sure that it's policed, the markets are properly policed. So just some views.
Thanks, Angelina. And Talis, your view on the trends, particularly with regard to the technological and the platforms aspects?
Sure. I think the fact that trading platforms for, say, traditional equities investments are becoming more accessible and lower cost, and literally you can buy and sell stocks with a click one click on a mobile app will get the job done, as opposed to going through a longer process. I think that's and also the costs of trading having come down for retail. That's something that's there, that's here to stay with us. Whether it's a good thing or not is up for debate. I mean, on one hand, there are efficiency gains that come from reducing the costs of these various frictions that would usually exist between people accessing markets. But there's also some research that my group have been doing that suggests that actually taking these frictions out of the market is not necessarily in the best interests of the average retail trader. And so what we've done is we've taken actual real participants into laboratory settings where we've simulated various trading platforms. And we've simulated existing trading platforms that are relatively clumsy and take multiple clicks to make a trade. And then we've simulated the newer versions of those platforms where everything is streamlined and the frictions have been completely taken out. And what we actually see is a difference in investor performance, and it's not favorable. It's not in the direction of benefiting retail investors that the costs have come down and the frictions have come down, because investors are making far more trades. That's explaining the higher turnovers. But they're spending less time thinking about their trades. So the quality of the decisions that they're making in our laboratory evidence suggests that the quality of decision-making has come down as you take the frictions out of the market. And that's an offsetting negative consequence to maybe think about from the perspective of retail investors. It also ties in with some of the existing empirical evidence that's out there that suggests the more active retail traders are actually those that underperform the market by more. And effectively, the reason is that there's, on average, not much stock picking skill among retail investors, and all that happens is that transaction costs become a drag on financial performance on the wealth of the portfolio. And so, the more people trade, the more they chew up wealth through trading costs, even if it's just crossing the bid-ask spread, because they're not paying much of a brokerage or an exchange fee these days. But that's still one of the main predictors of underperformance of retail investors. So that's one of the worrying aspects of this trend of frictionless, low-cost platforms. The other sort of trend that maybe we haven't spoken about here is a tendency for relatively high levels of distrust or dissatisfaction of centralized financial institutions. And that's a factor that I think explains two of these, at least an element or to some extent, two of these trends we've been talking about. One is crypto, being a decentralized asset, and the growth of decentralized finance as well. A lot of the activity that's going on there is in response to a distrust or dissatisfaction of the relatively centralized financial system that we have currently. But it also explains one element of why retail traders are taking more control of their own investments, which is they want to control their own financial destiny. And so as long as there's that distrust of centralized financial institutions, then we're going to see that continuation, I think, of that trend of retail traders in equity markets, but also a growth in decentralized finance and disintermediation of some of the centralized players, or partial disintermediation of some of the centralized players, which creates a range of different regulatory challenges that I think we're going to get into.
Absolutely. I think that's a really important issue as well. And one area I would like to explore, but maybe we'll come back around to it, is that is this an ongoing trend in terms of a greater move to decentralization, or if we've seen, or given we've seen some concerns about the true nature of decentralization and whether it is really truly decentralized, whether we might see the pendulum swing back. But I'd just like to ask Miles about trends, and also maybe we can move on to look at some of the risks as well that we're experiencing. I think we've highlighted a few of those, but the risks that retail may well be experiencing in accessing some of these newer innovative products and access channels to these products. Yeah,
sure. Thanks. And I mean, I agree with the observations and comments from Angelina and Talis. And just to sort of add on, as I already said, I think, yes, this increased participation of retail investors, which spiked during the pandemic. We are continuing to see high levels of participation as we move from the pandemic, 2022, 2023 onward. And I think, enabled by the new apps and platforms that Talis was talking about, and the information flows and gamification that Angelina was touching on, And I think this trend is, of course, it's great to see innovation and more access for people to the market. In some ways, it's really supporting financial inclusion. If we can talk about that in the context of retail investors having access to the market. So these are obviously very positive developments, but it's about looking at the risks and perhaps the drivers of that to ensure that retail investors at the same time have an appropriate level of protection from those risks and those new risks that they are experiencing or subject to. So to sort of elaborate on that a bit further, Jed, Angelina mentioned already increased appetite for digital assets and how we're going to see that trend unfold. And of course, there are issues there relating to the regulatory treatment of digital assets, in some cases crypto assets, obviously, which is obviously a very live issue for many policymakers and regulators around the world currently. And we're seeing different approaches there. This will take me to the G20 OECD principles on financial consumer protection, which set out one way of responding to or ensuring that consumers have at least a baseline level of consumer protection, investor protection, and I can elaborate on them further perhaps later in the discussion. I mean, another trend which is also a risk for retail investors that we also saw massively spike during the pandemic, and I think continues to be at elevated levels, is the risk of frauds and scams. As more investors have got into the market, as more investors are using digital channels, at the same time, there's an associated increase in fraudulent and scam activity. From our research of the experience of consumer protection authorities around the world during COVID, I think about 80% of authorities told us that there had been an increase in fraud and scam activity in their jurisdiction. And in most cases, that was at least by 25%, and in some cases had increased by more than 100%. So I think this is a very significant risk area, obviously, both in terms of the loss to individuals, but then the collective loss to investors, both in terms of the financial losses, but also then their loss of trust in the system overall. And I think this is a role where, of course, regulators and supervisors have a role to play in terms of combating and tackling levels of financial fraud and scams. In terms of how one might address that, well, I mentioned the G20 OECD high-level principles on financial consumer protection, which are the international standard for effective and foundational consumer protection frameworks. And at the OECD, we just did a 2-year review and update of the principles. And one of the things that was really noticeable in the now updated version that was published in December last year is an increased emphasis on the need to protect consumers from financial frauds and scams and the role of regulators there, and including protection mechanisms to digital assets, and also having in place appropriate liability arrangements in the event of fraudulent behavioral transactions. But obviously we can get into that further as the conversation goes on. So I would say yes, definitely some of the most significant risks facing retail investors are around different types of assets which may be regulated differently and that may not be always clear to the retail investor. Fraudulent activity and the increased levels of that, and the impact that has on investors generally.
Thanks, Miles. Quite a lot to cover in there, and I think we'll be picking up on some, just as you say, some of the issues around fraud and misconduct a little later. Just before we move off the trends, there's one area that got a lot of attention, which was all the issues around gamification, and which has been mentioned in passing. And I'd just be interested in your views, and perhaps Angelina, you might start with this, is just in terms of some of the gamification methods that have been used and how they have operated, and on what are the areas that retail investors should be aware of in terms of how they address these type of issues. Obviously, from a regulatory perspective, if we're operating in an environment where these games are not actually legal, and we've got a great question on that come from the audience, which I'll pick up on a little later. What's the type of issues that retail investors should be thinking about in terms of how they engage with these type of products?
Well, that's what you're seeing, and it's really interesting because for myself, without giving away my age, and probably everybody around the table here, we all grew up with Pac-Man, and we grew up with Tetris, and maybe these games that were very, very simple. But now, as we see, young people are growing up with really fantastic, amazing battle games, and you name it, 3D games, and so on and so forth. But what you're seeing is those same developers are actually creating trading games, as well as very slick digital asset platforms, as well as retail trading platforms. So the more it looks like a game, the more that young people who are used to now playing with these computer games are actually moving into and realizing that, gee, I can make money now. And you saw the play to earn growth that happened in many of the East Asian countries, where people were playing to earn and were able to make money playing games, and then taking those tokens and using them. And the whole thing fell apart, of course, as people didn't buy the tokens. And many of the people who spent a lot of money lost a lot of money buying those memes that allowed them to make tokens. So I think one of the ways to really get the message out there is a need for definite investor education, and just getting the message out there that, look, this is no longer a game. This is your livelihood. And if you're spending your parents' money, you can lose them, and you can lose it very quickly. And I remember in my digital asset experiences, many of the people, why did they trade? Is they felt like, wow, I'm just like one of those traders that trade at Goldman Sachs or JP Morgan, and I've got this great display and I feel like an adult trading. And part of that really empowers some of these young people who have not actually traded, but they're starting to make money. They can use leverage and so on and so forth. But they can also lose just as much in terms of trading, either in traditional assets or in tokenized assets. So how can we deal with this risk? Well, number one, regulation. Making sure that the platforms are actually acting or actually set up properly and protect investors. So we saw what happened with the mother of all breakdowns, which is FTX. It was a great platform. It worked well, but there wasn't the investor protection side in there, because basically we now know that a lot of the assets were stolen. On the other side is a need for investor education out there, and kids, and maybe there's a disclaimer. Maybe there needs to be more work in terms of KYC to make sure that young people like the age of 14, 15, who are now trading, may not be able to trade unless they go through tests and at least understand what they're getting into. Because when the easy money comes, they get attracted into it, and then the whole thing can turn. They can lose everything at the same time. So this gamification can be a major issue in terms of moving forward. And I would hope that parents as well as regulators are working with the industry to actually make sure that the guardrails are there. So I've covered a lot of topics there. I don't.
Might also ask Talis very similar approach, but also looking at has there been much academic research in this area, and how that has been used or misused in terms of how it's been presented to retail?
There has been research on gamification and what its impacts are when financial trading platforms have been gamified. One of the conclusions is that gamification is actually a very, very powerful tool, and it's worrying how powerful gamification can be. And that's a sort of a general statement, not just specifically about financial trading platforms, but gamification to influence human behavior is a very powerful tool. What really worries me about gamification is if you think about the ultimate objective of a platform designer that is gamifying the platform is to keep the player playing. And when it comes to financial markets, actually, the more you trade is not necessarily a good thing. It's not necessarily in the interests of the retail investor themselves. So there's a clear already at the very outset a misalignment between what the platform developer is trying to achieve and what is perhaps in the best interests of the retail investor, and that's a worrying thing. Ultimately, what in the mild form of the harms that come from gamification, it's perhaps retail investors trading too much and chewing up some of their wealth through trading costs, even if it's just crossing the bid-ask spread. But in the more harmful version of it, it's retail investors actually becoming problem gamblers through financial market applications, not through playing the casino, but it's in financial markets that you see problem gambling starting to emerge, and gamification is playing its role in that happening. And I can tell you personal anecdotes of individuals that I've seen that have decided to self-manage their own wealth as opposed to having it managed by a professional, that have effectively eroded their whole life savings by becoming hooked on financial markets and becoming problem gamblers. Now, we have a lot of infrastructure around casinos and proper registered licensed gambling to protect problem gamblers, but we don't see those same protections necessarily in stock markets. There's nothing that steps in the way and protects the individual that is trading too much in the market. But the consequences for the individual can be severe. I've seen cases where people have literally gone from having a very good retirement savings portfolio down to now having to jump onto the social security system because they have eroded their wealth down to virtually zero. But that also creates a social consequence, which is that everyone else has to pick up the bill for that. So this is one of the worrying trends, or one of the worrying observations about gamification of platforms. But I would say something about gamification, which is that gamification can also be used as a powerful tool for good. So gamification we're using in education settings, and we're finding it very effective in universities to gamify aspects of the learning process. And I'm now introducing gamification in teaching financial markets and trading to students, but using it in a way that is trying to teach appropriate principles of investing and important lessons about how financial markets work, as opposed to using it as a tool to get people hooked. So here's another sort of promising use of gamification, which is maybe in investor education.
You raise a really good point about the problem gambling and the whole point about the benefits and the costs. I wonder if we could just stick on that for a moment, Talis, and are there lessons that financial regulators can learn and use from the, I know we'll be talking a little bit more later about some of the regulatory responses, but just purely from the problem gambling responses that other agencies have dealt with, and also how you then balance that against what are maybe perfectly legitimate access questions that people may have about how you control what people may wish to do legitimately.
So in traditional gambling is an area that I'm not an expert in, but a few observations from the research that I've done around the periphery of gambling and the intersection of gambling and financial markets are that advertising and the way that gambling is marketed is a controlled, regulated area, and maybe we have to think about whether the appropriate controls are in place for the way that platforms or particular financial products are being advertised or marketed to, in particular, retail investors that may not be sophisticated enough to see through some of the consequences of the decisions that they, or the platforms they might get involved in. And the second thing that seems to be relatively effective in extreme problem gambling is the ability for someone that is able to self-identify as a problem gambler, or can be identified as a problem gambler by their family, friends, peers, counselors, to be actually banned from gambling venues. And I wonder whether that's a tool that's worth at least giving some thought as to whether such a tool would be appropriate in some settings in financial markets.
Thank you, Talis.
I think, Gerard, if I can just add, with digital assets has come increasing amounts of leverage. And what early on was more of a marketing campaign to be able to leverage 100 times, it's now become quite commonplace. And whilst experienced traders will never use more than 3 or 5 times, it's the inexperienced traders that like the effect of using 100 times leverage, either in digital assets or I haven't seen it in traditional products, but mostly in digital assets. So I think this is an area where companies also need to police more. As they do their KYC, if they realize that these are young people or underage people, they need to know what are the risks if you put in 100 times leverage versus 3 times or no times. And these are part of this whole informational process, as well as screening your clients. That'll be very, very important. And I think that's something that regulators can think about as they put out additional guidance for either digital assets or with the gamification and new trading opportunities come out in terms of trading services. So just something to think about too.
Thank you. Thank you. And Miles, from your perspective, particularly your earlier experience in terms of financial literacy and financial education, how far can these types of behaviours be addressed, given that in some cases they'd be obviously quite extreme, but in other cases there may be more kind of generic aspects that would be fairly straightforward financial investing behaviours?
Yeah. I think obviously investor education is a key part. It's a key approach in sort of addressing risks to retail investors and helping them to protect themselves. And there's obviously been a lot of work done to develop investor education approaches by many IOSCO members and other public authorities all around the world. And there's a lot of research that's gone into that. And I think a point that Talis made earlier in the discussion about frictions and the role of frictions is very important here. And I guess for me, investor education, we should take a very broad view of what constitutes investor education, beyond obviously sort of guidance sheets or what have you, but actually looking at sort of a whole range of different interventions that can somehow support or be relevant to investors at critical moments in the sort of decision-making pathway or the transaction pathway. And I think one of the issues with gamification and why it's so effective is, of course, because it manipulates people's behavioral biases and preferences and removing some of the frictions, making things very fast and accessible, and removing the frictions that Talis mentioned that actually act as points to slow people down in their decision-making process that might give a moment of reflection. Can I afford this? Do I really want to do this extra trade? Thinking about something else. And of course, gamification takes that away. And it also encourages a competition sort of mentality as well. So there's that going on as well. And I think that where investor education can be very important is to also apply those sorts of use gamification as part of the education process, again, as Talis mentioned. And I think we've seen this in a number of jurisdictions developing innovative investor education modules and tools where gamification techniques can be used to actually educate investors and help them make more informed and engaged decisions. But I think, as I say, broadly, we should be thinking about investor education, not just in terms of, as I say, delivering information to people, although that is important, but a whole range of different interventions and strategies that help, using behavioral science, that help people or through the sort of decision-making process, even if that means, as I say, putting in place some sort of frictions or sort of frictions in the decision-making process, so that they are forced in a way to slow down their decision-making, slow down their thinking before they commit to that next transaction.
Great, thanks. I might just move on to a slightly different topic now, which is artificial intelligence and machine learning, and the whole tiny little area that is suddenly expanding and mushrooming out to everybody's lives. With the AI has been around for quite some time and has been used in a number of very beneficial as well as some challenging approaches. I'd just be very interested in the panel views on some of the more established AI type technologies and machine learning, and I'd put in that as well, that some of the financial service providers and firms can use, but also what are, particularly with the recent developments, for example, ChatGPT, whether there are areas that are of particular concern for regulators in looking at this through a retail lens. Perhaps, Talis, if I could start with you on that question. I think we may have lost Talis. So while we're getting Talis back, Angelina, would you mind kicking off on that?
I think where you're seeing a lot of developments now, and a number of trading firms, as well as institutional investors, are already, as a part of their development of new systems, are already building machine learning into their trading systems. So you're seeing systems move faster, take advantage of potential areas where they can profit. And you're seeing the use of AI enhance trading. So this is only going to grow. And with the development of Web3 and decentralization, you're also going to see additional advances in terms of trading, as well as interconnectivity and decentralization. So with all of this, regulators really need to think about this because you're still trying to protect the integrity of the market. And you want a clean and level playing field. But if you are a technology company that can actually afford to ramp up and use artificial intelligence to actually amp up your trading, at what point does the market become not fair anymore? So these are some of the questions that regulators will need to think about in terms of some people use throttling, for example, to slow down trading in certain markets. But you're going to see additional advances in terms of speed and latency. And around the world, you're seeing exchanges have co-location sites where people want to get closer and closer to the exchange mechanism. So in general, regulators can also be using artificial intelligence, of course, for the surveillance function. And everybody has heard of smarts, and I'm sure every regulator probably on this call uses smarts or something like that. But you're going to see smarts probably getting smarter with artificial intelligence to hopefully pick out trends so that there's not so much of a human touch. But nevertheless, you still need humans to actually interpret the data. So whilst you have artificial intelligence to make the whole trading / surveillance or decision processes simpler, there will still be a definite need for humans to make a decision whether or not to take the case forward, to use this, or even to make the decision whether or not to use it. So those are just some of my views in terms of this. And I think the report that the Retail Market Conduct Report, all of these issues that you brought up in that report are good things for people to think about, especially in their market and how they deal with artificial intelligence or gamification.
And my apologies, my internet dropped right at the time that you asked me the question, but hopefully
I
I'm
hope
back
I gave
now.
a decent answer.
Good to see you back, Talis. Thank you.
But I
Good
could
to see
maybe
you
add a point to what Angelina said, which I agree with, and that is it's absolutely correct that AI has been around for a long time, but there's two things going on here. One is it's getting more powerful. The techniques are getting more accurate and more developed. But the second, the really big thing that I think that's happened recently is that AI has gone into the hands of the everyday retail. It's become much more accessible. It's now available to everyone, everywhere. Just as long as you have an internet connection, you now have access to AI tools, and that wasn't the case before. And what can happen in such a situation is you get unsophisticated users of AI that can use generic AI tools like ChatGPT, for example, to try and obtain answers to particular questions, such as what stock should I buy, or is investing in stock ABC a good idea, or what are the earnings projections for this particular stock, et cetera, where the answers that you get out of generic use of those types of AI systems can often sound very convincing, and the words are structured in a way that it flows very well, and to an unsophisticated user, it can appear as a very clever answer. But some of those answers can be actually very void of substance, and therefore dangerous to base financial decisions on the basis of answers that come out of those generic AI tools when used by unsophisticated users. And so I think this is a major risk going forward, that AI is now in the hands of every individual that's out there that may not have the level of sophistication that's needed to correctly interpret what you get out of a generic AI system. At the more high-end use of AI, what some of my colleagues have been able to show is that AI can currently beat analysts, stock analysts, very convincingly in a very consistent manner in terms of both forecasting, but also writing nice narrative around stocks. And so that's one context where I see that a lot of the manual work that stock analysts have been doing can actually be saved by AI systems that can draw on much larger data sets and see much deeper patterns that maybe individuals as analysts were able to see in the past.
Thank you. Miles?
Yeah, thanks, Jed. And sort of perhaps to add to the discussion, sort of because obviously the growth of AI is sort of impacting and relevant across all of society and the economy, and the sort of the developments that we're seeing take place there will impact all of us. In terms of the big picture policy space, at the OECD, we released the AI principles, which have been adopted by OECD countries and G20 countries and many others, which try and set a sort of a guiding framework, if you like, for AI, not specific to financial services, but across the board. And these principles touch on things that AI should be used to promote inclusive growth, should take account of human-centered values, should come with appropriate levels of accountability, should be transparent and explainable. So this sort of seeks to put a sort of, I guess, a big picture policy framework for governments right around the world, thinking about how do we navigate this ever evolving and advancing area. And I think Talis makes an excellent point that we're seeing AI move into the hands very much of individuals in society, which is a very distinct and powerful shift. And of course, like with all the developments, there are great advantages of this, whether it's saving time, saving cost, doing things more efficiently. But of course, then there come risks and challenges that policymakers and regulators need to be aware of. In the financial consumer protection space, through the high-level principles of financial consumer protection, in the updated version, we specifically mention AI and machine learning and the impact of digitalization and taking that into account in terms of appropriately protecting consumers and investors. And I think where that's sort of most relevant at a high level, trying to sort of set a high level sort of approach is in relation to ensuring that regardless of how investors are transacting, how they are accessing the market, the overriding notion that they should be treated fairly and equitably, I think is very important in terms of guiding policymakers, regulators and financial services providers. And I know that this notion of fairness is embedded in many investor protection frameworks, of course. I mean, and some of the particular risks from AI or enabled services, include the risk of inappropriate, biased, or discriminatory outcomes, which is I know something that is very a live issue for many regulators, supervisors, and policymakers. And here I think I'd say that overriding notion of fairness and appropriate outcomes for consumers is very important. But to pick up on Angelina's point as well, the need for interventions, and it may be human interventions, people, while overall algorithmic supportive decision-making models may be very good at a sort of a broad level, where in an individual case that is, there is something inappropriate or potentially discriminatory, there should still always be recourse to a review and remedial action if that's required. So I think it's very important to strike this balance between obviously supporting and encouraging innovation and efficiencies, but also paying attention to the outcomes on an individual consumer level as well.
Thank you. And it was mentions been made about the use of such technologies potentially in more fraudulent and illegal type activities. I wonder if you might move on to a discussion not just within the AI context, but more broadly about the technologies that are available to fraudsters, the use of new products, crypto, DeFi, and so on, and them mechanisms that have been applied in terms of illegal activity. Again, there with this AI lens, is this a whole new area that we'll see an expansion? I might ask Angelina to maybe provide a bit of speculation in terms of where we might be, where we have come from in the fraud landscape, and where we might be going.
It's interesting because the frauds are now becoming more and more sophisticated, and there isn't a day that we don't hear that somebody has been hacked, or there isn't a day that we haven't heard that significant sums of either digital assets or funds have been stolen. And I dare say, even with some of the things that have been happening in the United States, the dissemination of information, we don't know. But it seems that when a share price of a stock goes from $300 to $17, it seems that something is happening in terms of dissemination of information. Now is it fraudulent? I don't know. But when it shakes the integrity of the market, that starts to worry me, because there might be people or bad actors out there that are actually causing this to cause unrest, that might hide bigger issues that are out there, or people that might want to profit off of this news. For example, the information that we discussed earlier about the United States and some of the banking issues out there recently, the financial turmoil that happened in the United States. So, I mean, basically, financial frauds have been around, and I was a director of enforcement, and we've seen the pump and dump schemes. They're just becoming more and more sophisticated. The use of technology has made it a lot easier to approach people. You can hide yourself, you can mask yourself to be a little old lady that might be asking for help, and you're seeing all sorts of very sophisticated financial frauds coming out. And I think this is where regulators really need to be patrolling the beat. And I think companies that are fraudulent, then guess what? They should be listed on the regulator's blacklist that, look, you should not be dealing with these companies. And anything that looks unusual, it's probably good for regulators as well as consumer protection organizations to actually list those and call them out in terms of if there's financial frauds and scams. But just generally, the whole issue of investor protection and the whole thing about if it smells rotten, it usually is. And if it's too good to be true, it usually is. So I think all of that, I think we just need to take everybody back to the old fashioned way of if it doesn't smell right, don't get into it. And I think that needs to be really pushed over and over again, because even with FTX happening like this, nobody thought that FTX would collapse the way that it did. But when you read the report of how much incompetence and how much lying and how much integrity issues were there, I think this is something for all of us. It's a wake-up call that people should be careful and really study before they get into these financial frauds or scams. That's just some thoughts about that.
Thank you. And Talis, I know you have some very interesting examples of new and innovative frauds that have been undertaken, but interested in the examples that you have and your thoughts on how they might be addressed.
Sure. My group's been doing a lot of research on various types of frauds and scams that happen, in particular in cryptocurrencies and criminal activity that gets financed through cryptocurrencies. And one of the conclusions we've reached across a large number of different types of misconduct is that cryptocurrencies have, at least for the first for the recent years, been a real haven for fraud and crime for 4 reasons that I'm going to point out. But I would suggest that these things are shifting, and it's not necessarily the case that crypto will always be a haven for crime. What we're finding is the 4 key drivers of why so much criminal activity and frauds and scams are happening in cryptocurrencies. And number one, pseudo-anonymity, the fact that fraudsters can hide behind a digital address, being a public key, and as long as their physical identity has not been linked to that public key, then they feel safe. They're just a digital number that's floating around there in a network, and no one can pin them. That's a bit of a misconception in the sense that many fraudsters have actually been, and criminals have been tracked down, even though they thought they were able to remain anonymous. And largely where they're getting caught is the on and off ramps, where they're exiting the crypto system or ecosystem into the real world, or they're coming from the real world into the crypto ecosystem. So as we tighten up those on and off ramps with AML and KYC and decreasing prevalence of OTC, crypto markets, etc., there's less and less ability to hide behind pseudo-anonymity. The second sort of key driver that we see in particular in crypto frauds is the fact that it's been a very hot and speculative market with a lot of relatively uninformed individuals entering into the space, looking for quick profits and not thinking much about where those profits are coming from. And that's a perfect environment for a scamster or a fraudster to take advantage of those relatively unsophisticated individuals. So one of the things we're seeing with the rates of scams and frauds in cryptocurrencies, and in particular, maybe isolate one type that we've been able to measure very accurately, which is pump and dump manipulation schemes that get organized through Telegram and other social media platforms. They have been rising, but they've been cyclical. They tend to spike when markets are going up and new retail investors are entering the crypto markets, and they tend to decline the rate of these pump and dump schemes when markets cool down, as we are currently in sort of that cool phase of markets, and we see these pump and dump schemes have come back down as well. So that's the second driver. The third one is digital convenience. And if you think about criminal activity, a lot of it used to be done traditionally with cash because that was the way to stay anonymous in doing transactions. But cash is not very convenient, in particular for doing cross-border criminal activity or large-scale criminal activity, etc. And so now that we have digital forms of payment that are outside of the traditional regulated system where banks can identify who's making those payments, then a lot of this criminal activity that would just be happening traditionally offline with cash has moved online. And that's something that I think is here to stay. In the sense that it's just much more convenient to make payments online with digital means, same as we're seeing the decline in cash use for legitimate purposes. We're seeing a decline in cash and criminal activity and a corresponding increase in criminal activity online. And the third one is a perceived lack of regulation. That we've looked into a lot of the chat records of criminal gangs that are operating online, fraud gangs that are operating online, and Telegram pump and dump group organizers, and a lot of the conversations between them are about these markets, these crypto markets are completely unregulated. We can do what we want here. The rules don't apply. That perception is not quite accurate. And it's not quite accurate if you have a look at some of the court cases that are coming through the system at the moment, where traders in cryptocurrencies are being prosecuted in several jurisdictions for traditional misconduct, such as insider trading, market manipulation, etc. So that perception is incorrect, but while that perception persists, there's a heightened level of criminal and fraud activity in these markets. Again, that's something that's shifting through time. Some of these legal cases that are working through the system are going to really bring attention to fraudsters that, hang on, you can't do whatever you want here in this area and get away with it. And the second thing that's shifting more systematically is as regulations are being formed and as new licensing regimes are being formed in various jurisdictions around the world, as they come through, then that perception of these being completely unregulated markets is also going to dissipate. And along with that, I think we're going to see a decline in the rates of fraud and criminal activity and misconduct as well.
That's what we hope.
Indeed, and thank you for that, Talis. And you make a good point about the on-ramp and the off-ramp, and the role of AML regulators. It's an area that's explored in the report, is that collaboration between regulatory agencies, and that often with some of the scams type issues, it's not simply a single regulatory response that can come in. And I might explore this a little bit more with Miles, if I may, from your experience through the Financial Consumer Protection Committee, the FinConnect, and engagement across other international global regulators. What's your view of how we can collaborate more effectively across sectors for regulators to address some of these issues?
Sure, thanks, Jed. And I mean, I can perhaps before coming to that, just to sort of add to some of the evidence base around the prevalence of frauds and scams that both Angelina and Talis have talked about. We did research at the OECD, again, sort of in the context of COVID, and the experience of financial consumers, and increased heightened vulnerability to frauds and scams was identified by governments as the number one risk in high-income countries, and the number three risk in developing markets to consumers that had emerged through the COVID experience. And given the sort of ongoing high levels of retail market participation, I think we continue to see these high levels or elevated levels of scam activity, which, as Angelina was saying, are just becoming increasingly sophisticated and digitally enabled, of course. We researched the top 5 types of frauds and scams affecting financial consumers and investors. And the first one, the most common one, was phishing, tricking customers to provide personal identification information online. Also fake schemes, whether crypto or other types of schemes, to enticing people to buy, to invest in something which is obviously turns out to be fraudulent. Fraudsters posing as banks or financial advisors. Also vishing, which is like phishing but through voicemails and SMSs, of course. And then finally, the fifth most common type of scam were fraudulent messages purporting to be from government agencies. So I think this really picks up on Angelina's point that consumers are left with messages from what they think are their banks or their financial advisors, from government agencies, or phishing scams, which sometimes purport to be from the bank or sometimes from other family members. So the sophistication and the risk associated with scams is really something that's growing, has grown exponentially. in terms of sort of the policy framework and in sort of response to that, as I mentioned, the updated G20 OECD principles of financial consumer protection specifically highlight the need for public authorities to be working to combat scams through a number of different channels. One is through developing clear and transparent liability arrangements for financial services providers in the event of fraudulent activity, ensuring that mechanisms to protect consumers' assets are adapted to online technologies and new risks associated with digital transactions. And then importantly, and this was what we saw as the most common and many people rated the most effective way of addressing scams, is to have coordinated public awareness raising and warning mechanisms to the public for particular types of scams and particular types of scam entities. And importantly here, the principles make clear that financial regulators should be working with other agencies and stakeholders right across the board to make scam campaigns, scam awareness campaigns more effective. So to your point, Jed, I mean, that's obviously working across sectors in the financial services industry, but looking beyond that, to work with data protection authorities, of course, but also telecommunications regulatory bodies, utilities regulatory bodies, basically a whole range of different touch points where consumers are likely to receive information from. The more people that are spreading the message, obviously the more effective a campaign will be, and that includes financial services providers themselves. And that can be supported by actions such as, and I know this is very, very common, repeating messages from financial institutions that they do not contact people by SMS or email asking you to provide your account information. I mean, these sorts of things are really, really key, because in many of these scams, that is the thing that the scammers are after, people to provide their account information or access somehow, and then obviously it all goes from there. So yes, I think there's a very, very important role for collaboration across different stakeholders, across different sectors, to enhance the message and make it more effective.
That's a very interesting point about it, not just the financial regulators and regulators operating within that space more broadly, but also the access points through whether it's the telecoms firms and the social media platforms themselves. I'd like to, in the last period that we have left, to look at some of the regulatory responses and challenges. And there was an interesting question from the audience about how we address, or how we might address, issues that are not necessarily fundamentally illegal, but are creating harm. So traditionally that was put in the context of a harmful but legal type issue. So it's a two-part question, and I might go to Talis first, if I may. But in terms of bearing that particular point in mind, what do you see as the, are there any areas where there are particular regulatory responses that you see as more effective or more appropriately addressing the issues that we've talked about over the last hour?
It's certainly a tricky area when you're talking about things that aren't black and white illegal activities, but are maybe activities that are of questionable integrity or questionable from a moral or ethical standpoint. I wish the answer was education about ethics, but from what I've seen, and I have a lot of colleagues that actually work on teaching ethics and then measuring outcomes in terms of how likely people are to get caught up in various forms of misconduct, conditional whether they've had ethics education and not. One thing that we see in markets, and in particular when working with or examining misconduct in markets, is that when the stakes get high and when the financial incentives are there, the ethical reasoning goes out the window, irrespective of whether you've learnt ethical reasoning or not learnt ethical reasoning. And you see that in quotes that can be captured between fraudsters or market manipulators or insider traders that get revealed in court cases quite often, that they talk about things such as recognizing what they're doing is wrong, but we had to do it because the stakes were so high, or because the opportunity was just sitting there, was presented to us. So that's the real sort of challenge that's out there. What's one tool that I think could potentially be effective here is gentle reminders that we're watching, and here's what's allowed, here's what's not allowed. Even if what someone is doing is technically allowed, but of questionable, ethical nature, simply the notion that someone's watching can be enough of a deterrent. Simply a reminder that here is the border, and this is what's allowed and what's not, can be enough of a deterrent. And I'll give maybe one concrete example of where we've seen this play out. We were doing research on pump and dump manipulation of cryptocurrency markets, and one thing we observed is that these schemes that evolved in cryptocurrency markets were spilling over into equity markets. And we saw organized Telegram chat groups that were starting to manipulate, and in this case, the example that I'm going to draw on was Australian equities. ASIC, the regulator, did something that I thought was quite novel, and actually jumped into those chat forums and posted a message reminding the people in those chat forums that here is what it means to manipulate a market. Here are the data sets that we have. Here is the way that we go about surveillance. Just be careful, guys. And we were measuring how much of this activity was happening. And what we found is that was a very, very effective regulatory intervention. That reminder actually killed off that type of activity. And so that's sort of one thing that I would bring to the table, that those gentle reminders can actually maybe help people keep ethical reasoning front of mind and not let it slip to the back and sort of focus on the financial incentives.
Just to add, I think having case studies and especially as a part of what the SFC used to do is walking the beat and making sure that people knew that, and this is what you just explained, Talis, by being publicly there and calling people out. I think this is a novel way. And with novel times and new products and new services and new scam possibilities, I think this is where regulators really need to be very innovative. But it's also the investing public that needs to call out these people too. And if it smells rotten, then we should also, we as just normal people trading in the markets or hearing of this, should also be calling out these people and making sure that, hey, if it doesn't look right, maybe we should refer it to the police or to the regulators, because they're not, I mean, a regulator has maybe anywhere between 300 to 400 people working there, but they can't all be walking the beat. And it also becomes important for investors to be emboldened as well as empowered to refer cases and also calling people out. So this is something that I would really encourage regulators also asking the investing public, help us, help you. And nothing is more effective than neighborhood watch to keep away criminals. So if this is your neighborhood, then make sure that your neighborhood is clean, and that will actually spread.
Thank you.
I mean, I agree with everything that Angelina and Talis have said. And just to add to that, I mean, I think, yes, straightforward breaches of the law can be easy to identify and easy to take action on. But going beyond that, I think this is where we come back to this notion of fairness that I was referring to before, fair treatment for consumers and investors. And here, of course, regulators working with industry can provide guidance on what may constitute fair treatment for investors that sort of sits above or provides guidance above the sort of the minimal requirements of the law. I think the role of encouraging, to pick up on Angelina's point, encouraging investors themselves to call out unfair or unethical behavior and make complaints on that basis to the regulator. And of course, also the role of ombudsman schemes and alternative dispute resolution mechanisms here. Investors should be encouraged to make complaints to those schemes because very often they have built into their terms of reference the ability to look at cases beyond just the basic legal requirements and look at what is fair and reasonable in all the circumstances. And so very often you can build up through these ombudsman schemes and other complaints handling mechanisms, a body of case studies, which itself then acts as guidance to brokers and other advisors and other firms about what constitutes or what is likely to constitute fair treatment to consumers and investors in relation to any particular financial transaction or situation. So I really think the notion of fair and equitable treatment, which, as I say, is embodied in the consumer protection principles as a very baseline or a benchmark requirement, I think that's really important to consider here, and the role of guidance and working with industry to raise best practices.
Thank you, Miles. Are there any last points anyone would like to flag? Because we're coming very close to the end of our time here. And I will go to some closing remarks shortly. But if anybody has any last points, I think we've answered most of the points that have been raised through the questions.
Gerard, I think your report is just at a perfect time. And I think IOSCO taking an active part in covering the retail market is right front row and center right now. And I think continued work in this area will be very important, and working together internationally to strengthen the MMOUs and coordination and cooperation and collaboration will be very, very important from OECD, and working with professors as well as market participants to police as well as educate the market. So I think this is very, very timely. Your report is timely, and I think IOSCO's, this whole venue has been very, very timely.
My closing remark would be, as markets become more and more global and borderless, as the world becomes more digitized, and as we see a shift towards partial decentralization of markets and disintermediation of markets, organizations such as IOSCO are going to play an increasingly important role in global coordination of the rules and the individual regulators. So that's my closing remark, that this international coordination is important. And so this is where I see IOSCO and BIS and these other types of organizations as being the real leaders of making sure markets are working well globally.
Yeah.
Well, thank you. Miles, please.
Oh, no, well, just to say as a closing remark, I mean, thanks again to IOSCO for this opportunity to participate in the panel and discuss these important issues. I agree that international collaboration is essential here, and at a sort of a national level or a policymaker level, I've mentioned fairness a couple of times. I think keeping in mind what good outcomes for consumers and investors look like, and using that as a guiding principle is really important. So with all of these different permutations and different channels, distribution mechanisms, different players and all the rest of it, if we keep in mind what sort of outcomes we want consumers and investors to have from their financial transactions so that they retain trust in the system and all the flow and benefits of that, I think that's a very important thing to keep in mind. Thank you.
Thank you. And really, Talis, Angelina and Miles, thank you so much for joining us on this webinar organised by the IOSCO Asia Pacific Hub. It's been really insightful. I've found it a fascinating discussion, and I think the audience will have a few takeaways that they can think about and perhaps incorporate into their more day-to-day activities in terms of their regulation. It's indeed been a pleasure, and I'll now hand over to Shabana for some closing remarks.
Once again, thank you very much, Angelina, Miles, and Talis, for such an insightful discussion onto today's topic, and also to Gerard for doing such a fantastic job in moderating today's discussion. And we hope all participants found the session beneficial. As we always strive to improve, your feedback is vital to us, and we would appreciate if you could take a moment to complete the short questionnaire after the webinar ends. And thank you all for joining us today once again, and we look forward to seeing you again in our future programs. Until then, stay safe and take care.